It's Tuesday, May 23rd, 2023. Make sure to like, make sure to subscribe, make sure to share. But let's get right into what's happening today. I had a couple appointments earlier, and something that I'm seeing a lot more of, maybe you're seeing the same thing, comment down below, is I'm seeing a lot more dumpster diving. I had a couple appointments today, and in both locations, I saw people dumpster diving, going into dumpsters, going through the trash cans in the parking lot, the dumpsters, picking through it, male, female. And this is becoming much, much more common as we see more homeless people. We're going to see more people going through the trash. Have you been seeing this happening in your areas? And to me, this is just another reflection of this collapsing economy. More homeless people, more dumpster diving. Think about where people are right now, that they're going through the trash looking for food, looking for anything they can sell. It's just a terrible sign of the time. So I wanted to share that with you. But today, markets across the board in the red. Markets are waiting for the cavalry to arrive, for the Fed to come in and pause and lower rates and print money. They're waiting for this debt ceiling crisis to come to an end and come to a resolution so that we can print more money and continue to move on here, creating more inflation while we continue to kill the US dollar. So markets don't like waiting around. They want to see a resolution. They want the printing presses to wind up. And in the meantime, we'll see how it all works out here. But I was just printing a few articles here. Treasury to run low on cash by June 8th or 9th unless debt limit raised. This is coming from Goldman Sachs. Treasury cash balance was a little more than $57 billion last Thursday. Now, if you make $200,000 a year, that would be like having $200 in your bank account. And they're saying that June 1st could actually be the deadline. So what do you think? Are they going to raise the debt limit or not? I believe they're going to. I'm still in the party that believes that they're going to come to a resolution here. And it's not going to be good. I mean, just because we're raising the debt ceiling, it's not good news. It's going to mean that we're going to print a lot more money. We're going to cause a lot more inflation. On the other hand, we default and we feel a lot of pain, but we're going to default no matter what. So I don't know. Do we do it now? Because we're just going to do it later. And the later and longer we put this off, the worse it's going to be. Here's another one. U.S. debt default could send mortgage rates soaring above 8%. This also on Fox Business. Wake up, everybody. If you believe that mortgage rates are only going to go to 8% if we default, you are drinking the Kool-Aid. We're already above 7% right now. Many people are already paying 8% on a 30-year. So if you think it's only going to go to 8%, you're out of your mind. There would be such a huge negative shock to the housing market if the U.S. were to default, and it would be much worse than 8%. It will be well into the double digits. It's going to fall. Home sales are going to fall at a level overnight that we have never ever seen take place in this country if this happens. Again, I don't think it's going to happen. Is it possible? Yes, it's very possible. And right now we have no deal. And we're getting very, very close to the deadline. Whether that deadline is June 1st or June 7th or June 8th, we are getting much, much closer to it. And right now, anything is possible. Take a look what has transpired over the last 24 months. Anything is possible. Would you be shocked if we defaulted? I would not be. Is it possible? It is very possible. And every day this does not get resolved, it becomes more and more possible. Here's another one today coming from the Washington Post. It's titled, Corporate Bankruptcies Are Creeping Up as Pressures in the Economy Grow. The increase is visible among large companies, it says, where there were 236 filings in the first 4 months of this year. Filings will keep creeping up as interest rates rise, and all of that government support from the health crisis, that's gone. That is dried up. And sales growth is going to continue to slow. The economy is going to continue to slow. And we're going to see more bankruptcies, corporate bankruptcies, personal bankruptcies. It's going to continue to grow, and it's going to continue to accelerate. Again, another sign of what is happening in this economy. Just think how propped up everything has been. We've propped up so many of these zombie companies. Households have been propped up with all this easy money. Markets propped up. So much of this is such an illusion because it was propped up with $7 trillion pumped into the markets, into the economy over a 30-month period. And it needs to be sorted out. And so they want to just, I think, prop it up even more and print more money instead of just letting it fail. So we're going to see how it all plays out, who's going to crack here under the pressure, and are we just going to have an infinite amount of money printing? It's going to be another 5 trillion, another 7 trillion, another 20 trillion. Who knows where this is all going to go, but sooner or later, multiple things are just going to continue to break. We're watching the economy break right now. We see the volatility in the stock market. Housing now is so stagnant. It's just a matter of time before multiple things really break, and the engine on this locomotive completely overheats, and people are going to be in big trouble. The hedge today, Peter Schiff, the Fed is losing the inflation fight. You know, he made a really good point. We've seen a little bit of a sell-off in the last week and a half in gold. It's a little bit under $2,000 an ounce right now. I believe that as long as we see gold under pressure, under $2,000 an ounce, I think it's a good buy. That's not financial advice, but I think anytime you can buy gold under $2,000 an ounce, I think you're going to look back a year or two or three and go, wow, gold was under $2,000 an ounce and I could have bought it. But we are at a time right now where many Americans can't afford gold, they can't afford silver, they can't even afford to pay their bills because they have so much credit card debt, and they're using credit cards as a lifeline just to pay for food, the essentials, pay rent. And the last thing they can do now is buy gold, buy silver. And you know what? Unfortunately, they're still using credit cards to go to Starbucks and buy coffee. And they could potentially buy a little bit of silver. They could make some sacrifices, take on a side hustle. But many people won't do that because it's too hard. And many people complain they don't have anything, they don't have any money, but they're on Facebook posting pictures of an $8 latte. So that's how they're dealing with higher prices now in America. They're just charging stuff. Revolving credit card debt was up 17.3% in March. Average interest rate on a credit card now has spiked well above 20%. Peter made a very good point here. He said if the Fed couldn't beat inflation with 5% interest rates, how are they going to beat inflation at 5.25% interest rates? Very good point. They're not going to. And you know, I think that there is potential that we're going to see another rate hike in June. We could see a pause. If we see a pause in June, we're getting another hike in July. But there is a possibility we get another rate hike in June. The stock market, he says, is going up, and that is not a sign of a strong economy. He says the reason the stock market is going up is because investors expect a recession, and they expect the Fed to cut rates at the same point. And that's when the problems really begin to get out of control. Personally, I think the Fed has to be more aggressive. I think they have to be much more aggressive in raising rates. I think that a pause is very dangerous. I think they need to really push the pedal down and raise rates. And I think they need to stop protecting the real estate market, stop protecting the stock market, and start protecting the average citizen. They need to start protecting the U.S. dollar, because if they don't, we're going to have a much bigger problem than a recession or a depression. We're going to have hyperinflation in America, and that's when all hell is going to break loose. They've got to stop protecting markets and the housing market and the stock market, and they need to start protecting the U.S. dollar. Somebody is going to have to put their foot down and say, hey, there is going to be a lot of pain felt here. And the pain is going to be felt because of what has transpired over the last couple decades here. We kept rates too low for too long. We've inflated bubbles. And if we don't do something right now, if we don't put an end to the party right now, we are no longer going to have a country. We're no longer going to have a currency. And so by putting this off and putting this off, we are really playing Russian roulette here with the US dollar and the future of this country, in my opinion. Here's another one from The Hedge. New home sales unexpectedly surge in April as builders slash prices. It says here, existing home sales in March, that we had to make a revision in sales from from a positive 9.6% to a negative 2.6%. New home sales surged 4.1% month over month, thanks to a large part to a notable downward revision from 9.6% to 4% month over month in March. It's all about incentives, it says. So, you know, they could say it's up this month, it's up that month, but they don't tell you about the revisions that they made in the past month or the past couple months or 3 months in new home sales or existing home sales. Prices of new homes have been slashed. New home prices have fallen 8.4% year over year to a median average of $420,800. That's for new home. Prices are down for new homes, down 15% from the peak. That's a pretty big number. New home prices are down 15% from the peak. Don't hold your breath that we're going to see this rebound in new home sales, because as I make this video, 30-year mortgage rate, 7.03%. That's going to be a big problem. That's if you have 20% down. That's if you have very, very good credit. I'm going to finish with this last article from wolfstreet.com. It's titled, Prices of New Houses Drop. I'm going to finish with this last article coming from wolfstreet.com. It's titled, Prices of New Houses Drop Further. Builders Stimulate Sales with Price Cuts. And if you look at the average home seller versus the average home builder, the home builders are much more savvy. They're looking at their numbers. They're not emotional. They're just looking at the data, the numbers. They're looking about the bottom line. And so I think the average home seller has much more emotion in the game than the home builder. Unlike many home owners who are thinking about selling, home builders started cutting prices in the fall of 2022. I'm seeing homes coming on today all over the country, and they're completely out of their minds. The home builders are looking at the data every day. They know what's going on. They're much more savvy. And again, they're keeping emotions out of this. They're looking at the bottom line. Their business is to build and sell houses no matter where interest rates are or what they're doing. They cannot sit there, it says, and wait, pray, and hope that this too shall pass. They are using incentives, mortgage rate buy downs, cutting prices, whatever they have to do, throwing in new appliances, whatever they have to do now, they're doing to unload these properties. Where a lot of the homeowners and a lot of these existing home sales that are on the market, they're way behind, and they're going to continue to chase the market down until it's too late. And then they're going to really have to slash prices here. In my opinion, if you're a home seller right now, you need to be the next sale on your block. So you need to be the best price home in the neighborhood on the block to be the next sale. Otherwise, you're just going to continue to chase the market down. Every day, I get properties sent to me, and I'm looking at the numbers here in Southern California. I'm looking at the numbers in the southern part of the United States where I'm moving. And sales are absolutely falling off a cliff everywhere. And so you have to be very, very aggressive now as a home builder or a home seller. You have to be priced aggressively now. And so as a home seller, you can't do a buy down. The incentive you can give is being the best priced home on the block or in the neighborhood. And so we're going to continue to see sales plummet, and prices are going to follow at some point because people and sellers are going to be forced to cut prices in order to sell. And as I've said many, many times, somebody loses a job, the property might be an Airbnb, it might be a rental, whatever the case may be. That person at some point is going to say, hey, I need to sell this property. I have, 3 Airbnbs. They're not doing well. I'm going to have to sell this one. I'm not doing well in the market. I need to raise some capital. I'm going to sell my second or third home. My wife lost a job. I lost a job. We can't stay here. We're going to have to downsize. We're going to have to move into an apartment. Got to sell the house. And when time becomes critical, and you don't have a lot of time because the bills are piling up, maybe the mortgage payments are piling up, you're going to have to sell. You're going to have to liquidate. You're going to have to put in a very aggressive number on that property to sell quickly. So there's a lot of different things that could happen, and they're going to happen. And as we have a failing economy, as more people continue to get laid off, as inflation just eats people up alive, as people are going through their savings, as they're falling farther and farther behind on utility bills and credit card payments and car payments and rent payments and mortgage payments, people have got to sell things. So anybody that thinks that this isn't going to be as bad as 2008, they're not looking at the data. They're not looking at the condition of this economy. They're not looking at the condition of the average consumer and household right now. The debt that is piling up right now is going to be an absolute killer. The inflation that we have right now, way worse than anything we saw in 2008. The average household debt, the credit card debt, way worse than anything we saw in 2008. The job market, way worse than 2008. And the direction that this is all going in is going to be catastrophic for so many people who have absolutely no money saved up. 44% of this country doesn't have $400 saved up. How in the world can we even have a housing market when literally half this country doesn't have $400 saved up? Comment down below. Let me know your thoughts. A lot happening. Very, very interesting times, very concerning times, and very, very dangerous times for so many people. And we have no idea what could just fly out of left field. We have no idea what we could wake up to tomorrow or next week. All I can say is be the most prepared person you can be right now. God bless every one of you. Thanks for watching. Pray for this country. We need a miracle. And I look very, very forward to speaking with all of you very, very, very soon.